Hello, Facebook. Welcome to the 39.6 Facebook Live show where we talk about how to make your money work for you so you don't have to work for your money. Today's topic, Backdoor Roth Ira and why I should do one even if my income is high. Take it away, Pinky.
Hey, let's get moving.
All right, we missed Pinky yesterday. Thank you for the people who are here. If you're here and you can hear me okay, please give me a thumbs up. Give me just some sort of recognition so I know that the audio is working and the video. I'm trying to enjoy this orange lighting again for as long as it will last. All right, so today's topic is Backdoor Roth IRA. All right, thank you very much. Abby, thanks for being here. Okay, so today's question comes from the hospital and overheard is a discussion. Why would I put money and do a backdoor Roth if my income is already high this year and I'm going to have a lower tax bracket when I retire? Why would I want to pay the taxes now? Okay, so I haven't actually formally done an episode about the backdoor Roth, and so we might as well do one now, okay? So the person's question is, well, I'm already paying high taxes. Why would I want to put in Roth money? Roth money would make me pay taxes at the high bracket I'm currently at, and if I'm going to be retired later and have a lower marginal tax rate, well, why would I want to pay high tax now if I can have lower tax later? Wouldn't it be better not to put the money into a backdoor Roth? Well, the first thing is, if you are at your peak income, ultimately you want to minimize all of your tax liability that you have now because you're likely never going to have that marginal tax rate in the future. Okay, especially if you're a high income professional now and you're making like, let's say 300 something or more. Yeah, you're going to be at a lower tax bracket on retirement based on just your traditional like pre-tax 401k or pre-tax 403b withdrawals. Okay, so ultimately you want to utilize every single pre-tax dollar that your employer gives to you. Okay, so that could be a 401k, it could be a 403b, it could be a 457b, it could be a 401a. There are a lot of things, okay? So you definitely want to take advantage of every pre-tax dollar. If you have a high deductible health plan, and HSA is fantastic at also helping reduce your Social Security, Medicare, and federal income tax, okay? I'm trying to get the lighting to work well. I apologize, the sun's moving and the balance is a little off, but I'm just gonna keep on going with it. Okay, maybe it's better without the light. Okay, so definitely you want to take advantage of every single pre-tax dollar available, every little pre-tax bucket, okay? But after you've exhausted every pre-tax bucket, you only have basically two other buckets. You have like Roth buckets and you also have taxable buckets, okay? So taxable is the default. A taxable brokerage account, you invest money in there. The money that would go in there is already after tax. You've paid tax on the money before it went in. The same goes for a Roth IRA. The money has already been taxed, okay? So the person is right. You don't want to put money in Roth today if your alternative is to put in pre-tax today and you're at a high tax bracket today. But you don't have the option of pre-tax. Your option is Roth or taxable. Both of these have already been taxed. The difference between the two is that Roth money, once it's there and it's invested, it will never be taxed again in the future. Okay, with some very small exceptions, like if you're using debt to own like a rental property in your Roth IRA. Okay, but for regular investments, stocks, bonds inside of a Roth IRA at a regular brokerage place like Vanguard or Fidelity, etc., you're not going to have to worry about that. Your money will be tax-free forever. Now, if you put money in a taxable account, which is, again, the default account, then you're going to be paying taxes on the interest from bonds, taxes on the dividends from stocks, and taxes from the capital gains whenever you sell something. Okay, so taxable accounts are going to subject you to more taxation over the duration of that money being invested. Okay, once it's in the Roth IRA, it will never be taxed. Now, there's one benefit of doing taxable investing, and that is that taxable investing, you can do what's called tax loss harvesting, and that's a whole different topic in another episode. Okay, that's like super geek level stuff. Okay, and I'm sorry for the lighting. I'm trying to keep it even, but it keeps on fluctuating. So that's the reason why you want to put money into a Roth IRA if you can, when you've already exhausted every single pre-tax option. Okay. All right. I'm going to just try to stay right here and enjoy this amount of sunlight for as long as we can. I'll also move it closer, which I think might help. Okay. So how to do a backdoor Roth IRA. If you're married and your income is over $189,000, or in particular, what's called your modified adjusted gross income is over $189,000, you're going to be limited as to how much you can contribute directly into a Roth IRA. Okay, if you're single, that starts at $120,000, and if you're married filing separately, you really basically can't contribute directly without having be subject to a phase out. So basically, if you're earning more than $189K, $120K, if you're married or if you are single, you cannot contribute directly to a Roth IRA. And if you married filing separately on your taxes, you cannot contribute directly to a Roth IRA. So the only way to get money in there is to go through what they call the back door. It will still get into your Roth IRA, but you can't go directly. You have to go through a two-step procedure. Okay, and this, for some reason, confuses a lot of people, but it's really not that complicated. Okay, here's your Roth IRA, and here's what we call your traditional IRA. A traditional IRA has no income limitation. Anybody can contribute to a traditional IRA. Okay, anybody can. Anybody in the United States can. If your income is, if your age is 50 or higher, you can give $6,500 to your traditional IRA. If you are younger than 50, you can only give $5,500. Okay, that is how much you can put in any given year for any given year. Now, your deadline for making a contribution is not the year of the contribution. You actually get until April 15th or whatever that tax filing deadline is for that year for the previous year. Okay, so if you want to make a 2018 contribution to a traditional IRA, you can do that, and you can do that up until April of 2019. Okay, up until April 15th of 2019. Okay, now that is the first step, is just to get your money in there. The second step is to do what's called a Roth conversion of your money. Okay, to do a Roth conversion, all you have to do is basically you go to that account and you say, I want to do a Roth conversion of my traditional IRA. And that's it. You're done. Okay, it's 2 steps. Now, when it goes into the traditional IRA, it is going in as what is called a non-deductible contribution. This is where people get really confused. You don't really have to do anything to do that. You just basically put the money in the traditional IRA, okay? And when you file your taxes, you do not take a deduction on it. And in fact, there's a special little form you fill out when you do your taxes that says, hey, I did a non-deductible contribution, okay? That's gonna be 8606, form 8606, okay? Now you're gonna put money into your traditional IRA, but it's not deductible. And what that means is the money goes in there and there's no tax deduction, which means that the money is not pre-tax money. It's after-tax money. Okay, so this is why it gets confusing. A traditional IRA, people are used to it being all pre-tax money. And it is if you can take the deduction. But if you cannot take the deduction, it is in there as post-tax money. So your traditional IRA bucket actually has 2 components, pre-tax dollars and after-tax dollars, okay? Now, you don't want to have any pre-tax dollars in your IRA when you do, if you're doing a backdoor Roth IRA, okay? Technically, as long as all the pre-tax dollars are out before December 31st of the year of the contribution, then you're okay, okay? But to make this simpler, okay, we're going to say step 0 is take all of your pre-tax IRA money. That could be a 401k, it could be a SEP IRA, it could be a simple IRA. Anything that ends with IRA and anything that is pre-tax. You get all of those individual accounts that you have. Okay, well, I shouldn't say individual accounts, but SEP IRA, simple IRA, or pre-tax traditional IRA. You have to empty all of those pre-tax balances by doing what we call a rollover, where you are just moving them from one place to another place, from one account to another account that is also pre-tax. Okay, so the best example of that is if your work has a pre-tax 401k and it allows rollovers, you take any of those accounts you have and roll them into your work 401k or your work 403b, pre-tax to pre-tax. Anytime you go pre-tax to pre-tax, that's a rollover, and it is not a taxable event. You will not pay any taxes on that. You are keeping it protected from the tax man, okay? Now, step 1 then, after step 0, is to make your traditional IRA contribution, non-deductible contribution of $5,500 or $6,500, okay? And then step 3 is to do a Roth conversion, okay? That is taking traditional IRA money and then making it into Roth IRA money. That is called a Roth conversion. Anytime you do a Roth conversion, that is considered a taxable event because you're taking something that is potentially pre-tax and you're converting it to something that is now post-tax. You have to go through Uncle Sam, okay? Now, here's the catch. The money that you invested, it was invested into the traditional IRA as after-tax money, okay? So what we call your basis, your tax basis of that investment, which was the amount of money that went in there that was post-tax, that portion, when it gets converted to a Roth IRA, it was already post-tax. So post-tax to post-tax does not incur you any tax. Even though it is a taxable event, it is taxed at a rate of 0%. The IRS in general never taxes the same dollar 2 times, okay? So the money went in there as after-tax money. Once it gets converted from traditional to Roth IRA, it is still after-tax money, and you do not have to pay taxes on it again. So you are being able to do what's called a Roth conversion, but pay no tax on your contribution. Now, when you put the money into the traditional IRA, it may have earned extra money while it was there. It could have been, let's say, sitting in a money market investment, earning a low percentage of interest, like 2% interest. Well, if it was in there for 6 months, that $5,500 might have earned you like $28 of interest, okay? Now it's $5,528. Okay, if it was earning 2% interest for 6 months, it would have earned 1%. So it would have been 55, okay? So you would have put in 5,500. After 6 months, it's worth 55 or $5,555. That money is made up of 2 components. The 5,500 you initially put in, okay, and then the extra $55 that it earned. Okay, so the basis of 5,500, you do not pay any tax on that. But the earnings, the $55 of earnings, that money is subject to taxation. Okay, because that's not part of your basis. And when anytime you have a taxable event, the portion that's not your basis will be considered pre-tax money and will have to be taxed at your marginal rate for that year. Okay, so if you let it sit there for 6 months and it gained $55 and you're at the highest tax bracket of 37%, well, then you're going to be paying 37% of that $55, not a big deal. You're going to be paying like 1/3 of that, which is like $18. You'll pay $18 in tax. No big deal. Okay. But to make your life easier, what a lot of people do is once that money is inside the traditional IRA, like a day or two later after it settles and the money is available, you immediately do a Roth conversion. Okay. And then it doesn't really gain any money because it wasn't there very long. Okay. And so there's no extra money in there, and it makes it very clean. $5,500 goes in, $5,500 gets Roth converted, and there's no tax to be paid. However, you have to make sure you fill out your tax form properly, the form 8606, that tells you them that, hey, I put in $5,500 and that was my basis. And so when I did my Roth conversion, that is not taxable. I owe zero tax. If you're married, you and your spouse can each do this, even if your spouse does not earn any money. That's called a spousal Roth IRA, okay? So your spouse would open a traditional IRA and a Roth IRA also and do the same exact procedure, okay? So when you would file your 8606, it would have two different backdoor Roths on there. So instead of saying $5,500, it would actually say like $11,000, okay? So in summary, if you're a high earner and you've already used every single pre-tax dollar available to you, okay, or even if you're just at peak earnings and you're never going to go up higher, and you've already taken every single pre-tax deduction, well, there's no reason really not to use a Roth IRA for general investing. For those of you who invest in real estate, it's a kind of a different story because real estate is super tax efficient. But if you're not using real estate, then you should be using a Roth IRA to protect you from the taxes over time from capital gains, interest, and dividends. If you're over the limit, you can't go directly. So you have to put it into a traditional IRA first as a non-deductible contribution, and then you just do a Roth conversion of your money. And those two steps, it is done, okay? Remember, if you had any pre-tax IRA money, you gotta get rid of that first, just to make life simpler, okay? Alvin, what's up? Thanks for coming. Now, some nuances here. A lot of people get confused on the deadlines, okay? So for 2018, you can put $5,500 into a traditional IRA for 2018 in April of 2019. It could be April 13th of 2019, and you can do that contribution for 2018, okay? When you do the conversion, though, that conversion is done in 2019. So the conversion will show up on your 2019 tax return, not your 2018 tax return. So to make this a lot simpler, if you have the means to do it, it may not be easy right out of, for example, finishing school, okay? But anytime once you've started making money, just go ahead and do this on like January 2 every single year. Put it into your traditional IRA, and then on January 4, do the Roth conversion for that year. Then when you file your taxes for that particular year, you're going to file both. You're going to file the 8606 that has both the contribution and the conversion, okay? If you don't have the means to do the contribution for 2018 and during the calendar year, it's fine. You can wait till 2019 to do it. And in fact, you could do two backdoor Roths all at one time, okay? So you could basically do this. Let's pretend it's January 2, 2019. You could put in $5,500 for your 2018 contribution as a non-deductible contribution to your traditional IRA. Then you could also put another $5,500 the same day as a 2019 contribution. Okay, so you could do this all at once. I would personally do two separate transactions, but they have to each be tagged for 2 different years, one for 2018, one for 2019. Then on January 4th, the money is there and settled, okay? Now it says you have $11,000 sitting in your traditional IRA. On January 4th, you hit convert to Roth IRA. You can do this basically anywhere or call up the person on the phone. Very easy. You do that $11,000 Roth conversion, okay? If you're married, you can have your spouse do both a 2018 and a 2019 contribution on January 2. So you could have $22,000 going in to 2 separate traditional IRAs, $11,000 each, okay? And then on January 4th, you Roth convert both of them. So now they're both past the Uncle Sam threshold. They're in the Roth space. Okay. And you basically, when you file your taxes for 2018, you don't have to, you have to file the form 8606 that says you did the non-deductible contribution to the IRA, $5,500 each, but you did not do a Roth conversion that year. So that part does not exist. But in 2019, when you do that tax return, you'll say 8606, I did $5,500 each for non-deductible contributions, but you did a Roth conversion of not $11,000, but $22,000, because the Roth conversion is taxed based on the year it occurs. You do not have any deadlines on a Roth conversion. This tricks a lot of people up. You can do a Roth conversion on December 31st. You can do it on November 16th. You can't do it on September 31st because that date does not exist. Okay. But you can do it any day of the year and it'll be taxed for the day for that year it occurs, the calendar year it occurs. Okay. And it's that simple. One extra technicality, if you had if you had pre-tax money in a traditional IRA, SEP, or simple IRA, okay, and let's say today is September 17th, if I had money in a pre-tax, any of those today, and I decided I wanted to do my backdoor Roth today, I could go ahead and put $5,500 into my Roth traditional IRA, non-deductible, and I could do a Roth conversion today, okay, of $5,500. Now, as long as by December 31st, all that pre-tax money is gone and rolled into somewhere else and does not exist, it's technically still okay. Okay. However, that is going like way into the weeds, and I am not a CPA. I am not your advisor. I am nobody. I am somebody who makes $0 doing entertainment shows on Facebook Live talking about financial topics, really nerdy topics. But that's ultimately how it works. But you want to keep life simple, move all the pre-tax money away. Okay. Do your traditional IRA contribution and do your Roth conversion. That's it. Okay. Now, that's really about it for that topic. Definitely, basically everybody should do it. I'll be honest with you. And I've lied in other episodes. I always say I do this on January 2. Technically this year, we did not do it on January 2. We were saving up for a different investment, and we do peer-to-peer lending with our Roth IRA. All of our Roth IRA money right now is actually out on a project, and it's been since last year. So putting $5,500 in there isn't going to do us any good just sitting in cash. So I'm actually waiting till that money comes back to us. I'll put in the $5,500, do the conversion, then I'll have a larger amount of money and just kind of invest that all in one project. But anyway, in general, you should just go ahead and do it in January every year. Make your life simple. It's on your little checkoff list of things to do on your New Year's resolutions. Fill up these small buckets and get that all done in January. Okay. And that's it. So thank you guys for coming. Just going to say hi to the people here. Amulia, thanks for coming by. Ryan, yes, this pink shirt is like, I need to get like multiple of these pink shirts. I actually just put it on for the show, and I wear the same one every day at the moment. Don't tell anybody. But yeah. Oh, by the way, I'm going to give a shout out to Ryan, who is A, speaking at FinCon next week, which I'm super excited about. B, he's nominated for a Plutus Award. And so shout out to Ryan Inman. His season 2 is off to a killer start. Maybe one day I will be on his show. Maybe. He actually on Stacking Benjamin's podcast on Sunday, a bonus edition. Yeah, they gave him a shout out too, because he was announced as one of the nominees. Vivek, thank you very much for showing up. Alvin and Bantu and Abby. Okay, I'm glad I got the lighting figured out basically just halfway through. Yes, my background looks fake. Do you have those blue? What did Alvin say here? Okay, here we go. I'm learning this whole BeLive thing. Your background looks fake. Do you have those blue curtains like in Hollywood? Nice. They're actually green curtains, okay? For some reason, they decided that green would be the neutral color that makes things disappear. If it were really green, these cacti might actually disappear because they would be like see-through. and it would show the background. So no, it is not a green screen. That is actually real life. We just moved a couple weeks ago. I have a home office that I started setting up yesterday, but it does not get this killer background and the lighting. So I keep sitting here at the dining table because it's just so awesome. I just love the background, but there's no whiteboard. I might go like Good Will Hunting style and like draw on the glass. Maybe. We shall see. And that is about it. Yeah, Ryan, dude, honored to, I appreciate your show. You guys are doing an amazing job over there at your podcast, your blog. And if you see there, he's got his FinCon background. So that is super exciting. That will be next week, Thursday, Friday, Saturday, Sunday in Orlando, where all the money nerds get to hang out with the mouse. Okay, so that is it for today. Thank you. Until episode number 23. Think about what you can do for think about how you can make your money work for you so you don't have to work for your money.
Let's get moving.